Thank you for joining iMeet. When you hear the tone, you will be the 18th person to join the meeting. Now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And today we're going to quickly review last few days' action in the market, take a look at what may be happening this week, and then we're going to just take a look at the different indexes to start out with. And then we're going to do something like we did last week again, and that was last week we talked about where we could get some trades out of energy and I forget the other sector. Oh, and healthcare. Had a couple of nice trades out of that. And those are also doing fairly well this week. Now, what we're going to do is let's look at two other sectors that may surprise you that I think we can get some trades out of and put some money in, especially for some of the older guys. So what we're going to do is look at last week's action. A seesaw week. Here's the Dow Jones. We saw over here it was going sideways in this little tight range. Fell out of bed on Wednesday. That was the worst one-day drop since a 394-point drop on 9/9/16. It was about 2.1%. The NASDAQ actually had a worse day. It was the worst day since Brexit when it fell 202 points and lost 4.1% on that day. So it wasn't quite as bad as that, but we had some interesting things going on. We had the Dow Jones and the S&P 500 actually gapped down below their 50-day moving averages. You can see over here, kind of almost down to the 100-day moving average, and then we've bounced back up and had a couple of days in a row. I think this is the fourth day in a row now that we've been able to work our way higher, and the indicators show that. We came back down to the 50-point where it actually was going to be a sell on the 30-day stochastic, bounced off that 50, and we came back up. CTI is still positive 7. Which was unchanged. It'll be 7 at the end of this week, and then we'll start to slide down. So I think we probably have a few more weeks so that we can maybe work our way higher. Momentum's basically still it's a 1. That's neutral. Sentiment is still 0. It's a neutral. There are a couple bearish reads in there. The percentage of bullish advisors are still too high, up around 58.1%, and the bearish advisors are still too low at 17.1%. Now, the reason those are contrarian indicators, and the reason they are, if all the advisors are bullish, usually they have all their money committed already. So who's going to buy stocks to work things higher? So in the last couple of days, we've worked our way back above the 50-day moving average, which is a plus. We're back basically where the Dow Jones is looking at 21,000 again. We're at 20,940 today, up about 0.25%, up 45 points. And the S&P 500 is butted up against 2,400 again, which is where it is exactly right now, 2,400 on the nose. So the good side, the good thing of this right now is this. This is despite that sell-off and moving up. And here's the NYSE advanced decline line, and we made a new high yesterday. I think that's most technicians actually kind of look at that as an indicator of a leading indicator, which means that most of the stocks are still under accumulation, and so far that's leading me to think that we can probably get one more breakout to the upside before we kind of go into the summer doldrums and things begin to work lower. My target for the Dow remains 21.5, and it's all it's all going to matter. What matters here is if you keep an eye on that S&P 500. Once we get up to about 24.05, that's right. I think then we'll probably get one more spike. The target on the S&P 500 is up here around 24.40, which would be the second resistance line after we break through this line here. Now here's the S&P 500. Again, you see the gap down on Wednesday. We've had a couple up days in a row now, and we're back up to the 2400 spot where we've run into it 1, 2, 3, 4, 5, 6, 7. So it's formidable resistance up here. However, you're seeing a little bit of improvement in the indicators down here, which again We came down to the 50, moved up, good accumulation on the AD line. And I think that, like I say, once we get a little spike through this 2404, 2405 area, we can get ourselves a run up here over the next couple of weeks to around 2435, 2440. I would think that's probably a pretty good bet. Okay, here's the NASDAQ, working its way up this channel. Came down here, hit it up there, ran almost to the top, up again, came all the way down, almost to the channel here, which is right around the 50-day, and now we're working our way back up. The top of this channel represents 62.44, which, if you've been reading the market letters, that's what we have for the last couple of weeks. That's been the target, 62.40. I think we can probably get it over there. We were overbought if you look down here on several indicators, the 14-day RSI, and here also in the 30-day stochastic. So I think that, we worked a little bit of the overbought condition off of the NASDAQ, so we can get through here. I think we're up close to making a new high today. No, we're not either. We're at 61.42, so we've got another 20 points before we can break out to a new high today. The NASDAQ AD line isn't quite as rambunctious as the NYSE. You're still having a lot of more money going into the Apples and the Microsoft and Facebook, the FANG stocks, working its way up there. I'd like to see this thing, if we're going to break out, at least come back up to this area up in here. That would just show that you're having a little bit more, especially on the small caps, showing some more accumulation. The Russell 2000 is lagging the rest of the market right now. That's a little bit troublesome. We'll look at that in a minute. All right, we always talk about this. This is still the this is what still keeps us honest in here. We have this downward sloping channel in the transports. We came up here, bounced across that, couldn't get through that, came down, tested the 200-day moving average last week and bounced off of that. Even the indicators are still pretty much neutral on this. The accumulation is neutral. It's just not a great looking chart. We want to see this thing get up to about 9,200 on the transports. They're up about 44 today. We're at 9,010. So again, we're just right about here. Not even up to the pivot point yet. The pivot point on this thing is around almost 9,100. So that would be a plus. And then you get up here and you'll wrestle with the 100-day moving average and the 50-day around that area. And if we can get through that, that's going to be bullish for the broader market, to say the least. This thing comes down here and takes out this 200. That could be trouble. We always keep watching this thing, and it seems to just perform just well enough to stay out of trouble. But you got to keep your eye on this in the background. Now here's the other one that it's not doing too much for us right now. This is the Russell 2000, the small cap index. We're not getting any favors here either. This is always, you want to see this. This thing's been going sideways basically since December. With tax cuts and that type of thing, the small caps should be one of the beneficiaries of that. So we need to break out above this here. We did it one time. This is called a throw over in technician terms, and it came back down to the channel. We want to see this thing get back above 1390, 1400 and break through that. If we do, we can get another run on this thing, maybe up to around 1440, something in that range before we get out of bed. But we're seeing a little bit of negative divergence down here on the 14-day RSI. The MACD is also not showing much momentum to the upside, and we were oversold on the 30-day stochastics. We're bouncing off this 20. We want to see this get back above 50 to see what before this thing really goes. But this in the transports just cannot get out of the way here, and we need participation from them going forward. All right, last week we tried to make some money on the energy sector and healthcare. There are a few stocks that did outperform despite that sell-off. And what I want to do today is we're going to go back and look at a few ideas. I had some nice emails from people saying they like the idea where I give a couple stocks that we look at that we think we can make some short-term trades on. But this is going to sound a little strange now. We have the market that's pushing the envelope here to try to make some new highs. And what we're going to look at today is actually something's going on with the bond market and the stock market are diverging. In this case, what we have up here, this is the 7 to 10 year Treasury bond ETF. The symbol in this is IEF, Ida, Edgar, Frank. As you can see, this has been working its way up. Now, this is the bond. When this goes up, that means yields are coming down. And if you've watched since March, we had a 2.6% on the 10-year Treasury. We're down right now to about 2.27. The yield's actually down a little bit again today. And to me, this isn't something's going on. When you're in a rising, if we're in a really strong environment where rates are going to have to go up to slow the economy down a little bit, you shouldn't have this going on. What you're looking at over here, you have a nice bounce off of this support. The technical indicators are all bullish. And as you see down here, the accumulation, the people are buying bonds again down here, which is kind of surprising with what's going on. Okay, here's the other one. Now here's the shorter term bond. This is a 3 to 7 year bond. I can go back here and do a Fibonacci retracement. We've already retraced 50% of this whole move down to where we can start getting the bonds, the yields higher. And now we're gonna take a step. We already crossed over this downward descending trend line. We've gone ahead above that, and now we're taking aim at this 61.8 retracement. We've retraced all of that. And generally, if this crosses above that, there's the probability of this retracing the whole amount actually goes up. This is something that the technicians will watch. This is going to be resistance here, which also comes into play going back to this area. But if that IEI, which is the ETF symbol for this, Ida, Edgar, Ida, breaks above this Fibonacci retracement, this resistance area here, that we could get a move on rates lower. Now, what causes that? I don't know. That's when you read the charts, you just you take what they tell you. You don't try to analyze it. And what this might be saying is that right now, I think it's something like a 90% chance that we're going to get a rate hike in June. But if they come out and say things are slowing down, or they really come back with a dovish comments on that, you may have a spike in the bonds and then have them start to come back down again and have this start to work its way up. So I want to keep an eye on that. Again, you can see the accumulation in this. People are buying the short-term paper on that, and that's telling you that the bond traders are looking. They don't see the economy working out. Now, maybe that's because they're telling us that the Trump's agenda is going to be pushed way out, something like that, or it's just not going to work. But they're taking on defensive positions now. What happens when you go defensive? What looks good? Consumer staples. As you can see that today, we're broken out to a new high on the consumer staples. That's a conservative play. Industries in this group are beverages, food, tobacco, non-durable household goods, appliances, personal products, that type of thing. So what I want to do today with this group and another group that we're going to look at in a minute is see what we can go back to the industry group analysis on end market edge, and we want to see, okay, if this group looks so good, what industries, when we go by relative strength, are actually outperforming. I came up with one that's beverages. If you look at this right now, we have beverages it's outperforming the S&P 500. We can look at a couple stocks in here that have great looking charts. You think this is boring? This is CCE, which actually was used to be Coca-Cola Enterprises. It's now Coca-Cola European Partners. And we talk about that the economy over in Europe is improving. Well, this is showing that that Coca-Cola European Partners are doing well. It's breaking out here to new highs. This stock went into the growth and income portfolio a few weeks over in here, and it's had a nice little run up here, very steady. It also has a good yield, about 2.25%. The indicators all are bullish. A little bit of profit taking right over in here. The indicators still look like this could work its way higher. So that's one that for a more conservative play. And what I think for the next leg up, if we get a little bit of a breakout, you'll have your big tech and maybe in healthcare stocks probably lead a little bit. But then I think what's also going to hold the bottom and will be some of these defensive sectors and stocks that we're going to look at. Okay, everybody's favorite thing to do here is Anheuser-Busch. Here's Bud, B-U-D. It's working its way up a nice upward channel. It broke above there, gapped up on their earnings, came over here, came down on Wednesday, and now it's working its way back up again. You're getting you had a little bit of a pullback on this, which was good. We're a little bit overbought, but the accumulation is strong. Bud is a stock that you can look at over here. Most of these aren't very cheap, but they're they are going higher at this stage. I think this one here, like the CCE, you got to run back to the old highs. So you can get a trade in Coke or in Bud over here from about 115, 116 up into the 130s anyway. Okay, speaking of Coke, here's KO, Coca-Cola, also working its way steadily daily, just a little bit at a time. Nice looking chart. Indicators are confirming the move to new highs. You want to make sure we don't get a double top over here, but if we get above $40, $45, you can have another breakout, especially on the point and figure. It would be a spread double or triple top breakout to that. But this looks like it's going higher to me. This would be one, and you're in a strong sector, a strong industry in a strong sector. The brother stock over here, Pepsi Cola, PEP, came down here, tested the 50-day, and it's breaking out over here. You had a nice breakout over here around 115. It's higher today. The indicators are moving up. A little bit of negative divergence right here on this, but that's not bothering me. That just calls for choppy trading from this area right here. PEP would be one. Also pays a good dividend. These stocks are also, these foreign economies that are coming out of a slump. These beverages, beer, and for Pepsi especially, you have all the snacks and that type of thing. I know, and some of their restaurants and stuff would be yum. But these are stocks that allow you to buy an American stock and still get some of the growth from the foreign economies. All right. Here's another industry group in that same in the consumer staples. This is home furnishings and appliances. Has had a real big pullback here. As you can see, it's kind of a choppy chart all the time. But again, this thing's breaking out to new highs. It's outperforming the Dow. If you look, there's a list of stocks in here you can take a look at. The first one up there is Stanley Furniture, the penny stocks. We're not going to look at that, but here's one that's had a pullback to support. This is Herman Miller Furniture, MLHR. They make office furniture. You can get a little bit of a pullback over here to the 50-day, to 100-day, to 200-day. They're all converged in here. You're almost oversold in here. I think you can probably get a little bit of a trade in here. You want to make sure this doesn't fall below those moving averages in there. I'm not sure what it's doing today. Let me check real quick. Okay, so it's unchanged at 31.67, so we're still sitting right in here. But if this thing comes up here, you might want to wait till it gets above 32 and change. But that would be one in a rising sector. Here's one that I think these things are boring. This is called Restoration Hardware. The symbol is RH. This one I think it's a little bit overbought to buy right in here. It isn't one of the portfolios, but it's almost retraces 50% of the move back here from 2014, where it fell out of bed. Everyone shorted it, but now it's on its way back up. Great numbers on it. I haven't been in one of these stores, but I've heard some good things about it. Overbought, but if you think these stocks are boring, this will show you the hat. There's one $100 down to $25, and now we're back up to 68. As I think it was higher today. We bought this in the small cap or aggressive small cap portfolio. It's up about 60% from that. So I think we bought over in here somewhere. But the indicators look, this could work its way higher. I'd be a little bit nervous to jump in there and buy that. But I just put that in to show you that these aren't exactly just boring stocks. Now here's one that came up that we bought in a portfolio over in here a couple of weeks ago. This is called Hooker Furniture, HOFT. Harry, Oscar, Frank, Tom. It's having a pullback down here towards the pivot point and the 50-day moving average. This might be one that you can accumulate over here and look for a pullback. Nice accumulation on the way up. Okay, other stocks in here that were in that same group. We might look at Whirlpool. There's one called SCSS. I'm not sure what they do. There are a couple other ones in the industry group. But some of the other groups that came up were food retailers. Rather than go through a whole bunch of the same industry group charts, here's one called Cisco Corporation. They supply restaurants and stuff with the food groups. They deliver it. The symbol on this is SYY. Great looking chart over here. You have this coming up here, going to come around here, around the bottom to go up here and maybe break out the new highs. Confirmation by the technical indicators look good. Rising things. We want to wait for a little bit of a pullback down here to the 53 area to check that gap out. Looks like it already came back and kind of saw where the gap was, and now it's working higher. But Cisco's one. Here's another one. Great looking chart over here. It's called Pinnacle Foods. The symbol on this is PF, Paul Frank, breaking out the new highs over here. A little bit overbought. That might be one you want to watch too. Got a good buy on the 30-day stochastic over here off of this little rounding bottom here. A nice accumulation all of a sudden. So this must be an earnings breakout or something like that. Even some of the food stocks like Domino's Pizza, things like that, where I've heard a lot about all these kids sitting around playing video games, and they all order pizza and stuff to eat while they're sitting around playing video games. So those might be good. I guess you consider some of those would be considered retail, some would be consumer staples. It all depends how you look at it. But another one in this area is tobacco. Here's the S&P 500. Here's tobacco. You may have a problem with some of these stocks if you don't like to buy stuff that you're against. But here's Reynolds American. Look at this thing. Just every day it goes up a little bit, right in the middle of its channel. This is RAI. Also pays about a 3.6% dividend. The indicator is a little bit neutral over here, but pushing up towards new highs over there. 95 and 30-day stochastic. As long as that thing stays above 50, it's usually a good buy. That's one you can put in there, especially for dividends. Again, it's a 3.6% dividend, and that's one that you can look at for a longer play as far as going defense. All right, now this is another one that it should be surprising to you. Keeping with that defensive theme, the other sector breaking out is utilities. Again, why would this in a rising rate environment, if we're going to have such great growth, why are utilities also breaking out to new highs? It just seems to me that we may be getting ahead of ourselves as far as the growth potential on that, which would come into play if we get one little breakout on some of these growth stocks in technology and healthcare. Then we start to sell off. These would be stocks that you want to own. Now this is in a nice tight trading range over here, not doing much of anything, and we just started to break out here. Basically, I think yesterday, the indicators look great. Look at this accumulation. This isn't something that people are just coming onto and saying, yeah, these might go up. They're adding the positions, and it may be a little bit shocking, but apparently people are thinking the Trump's changes are going to be pushed down the road or pushed out for a while. And if that's the case, and they quit raising interest rates, then the utilities should outperform. And this chart's telling you that you can buy this and probably make some money. But look at the industry group analysis today. We saw that electric utilities was actually upgraded today to a long. So it's had a nice little pullback. This might be a chance to pick up some of these electric names cheap. And they're again, you have some nice looking charts on these. Here's one called PPL Core. The symbol is PPL. So coming up here, it's gone from 34 up to 39, just a little bit higher every day. Look at the accumulation on that thing. Again, you're getting confirmation from the technical indicators. This one pays about 4%. So you've actually took out this old high over here, this area where you kind of have some resistance, and now you're breaking out some new highs. But this looks good to me. Here's one that also has a great looking chart. Detroit Energy, DTE. It pays around 3.08. A little shocking to see some of these charts and what they're doing on there. But again, good accumulation and breaking out the new highs. Another one here, El Paso Electric. EE is the symbol on that. That's another one that pays, I guess it's about 3.5%. Just had a point and figure breakout yesterday at this stage right here. So again, confirmation from the indicators and moving higher. Another one that came up in that group that's coming up is gas companies. Surprisingly enough, gas is building up. However, here's one called NiSource, NI, which has gone from low to mid 20s up here to about 25, 26. Pays a nice dividend. Again, the great accumulation on this thing, and you look at the MACD breaking out to the upside. Another one in the gas area is New Jersey Resources, just steadily moving a little bit higher. kind of in a little bit of a range here. It looks like it's going to probably break out to the upside of this one. This is NJR. Again, you have some nice accumulation in that. So another defensive sector that I recommended a few weeks ago that had a pullback since we talked, but it looks like we're starting to get some upgrades again on some of those. And if we, if the interest rate environment does come to a halt for a while, we get a little bit more dovish from the Fed. I think the Fed meetings minutes come out yesterday or tomorrow. I don't expect any surprises in that, but we might get some surprises coming out in June. So surprisingly, I think that the leadership in the market right now is defensive sectors. The utilities and the consumer staples are breaking out to new highs. The technology still looks good in the healthcare, but once if this thing starts to slow down and we start getting some hints that rate raises are off the table and the economy actually is slowing, and we've already got a little bit of our boost, then those other sectors are going to be the ones that are going to come down the fastest, and where you want to come out of some of those positions. So I'm not saying sell all that and jump in and go completely defense, but I think that you can nibble away at some of these stocks. So if we do start to get a pullback, you'll have some nice positions that'll probably jump up while the market's going down, and you'll be able to save some of your gains, and you won't just be totally into the growth area. Okay, what I want to do now, we'll open up to some questions. Again, when I saw some of these charts, I was actually surprised myself to see the strength in some of these industries that are going on right now. Also, I want to bring up one more point. If you would like to be included to get access to the beta site with the new charting package, the new second opinion page, they have a chart on that now. It looks good. What I want you to do is just take your name and email support@marketedge.com and just say I have set me up with the new beta site, and someone will get back to you probably later today or first by tomorrow morning anyway, and you'll have access to that site. That way it won't be so new. We'll be working both sites for a while, just so some of the older guys and stuff don't freak out that we change things on them. But do that. Again, support@marketedge.com. And we'll open it up here right now. Okay, the list status feature is not on the beta website. I always use that on my watch list to track performance. Okay, I will make sure they have that. I guess it also needs to be in the stock watch feature too. Now, the second version of the beta coming out pretty soon, you're going to be able to track all your portfolios in stock watch, or you can put the price you bought them. Maybe you'll be able to put where you want to stop, visual stops, that type of thing. So we have a lot of other things that will be coming on the second round of this beta thing. But go ahead and do that. I don't see any other questions coming in, but I will come in. We got one more here. What's your opinion on closed-end funds, DNP and CHI? Let me look real quick. DNP. Select income fund. It looks fine. I don't see as much accumulation on here, but again, you're having something that's stepping its way up, and the CHI doesn't look as good, but I can see an uptick in the. This is Calamos Convertible Opportunity and Income Fund. The other one has a better chart, the DNP, and again, that's another fixed income type of investment that's going higher, while we're supposed to be talking about great growth and rates going higher, which again is something that we're having a divergence with the bonds and the stock market. And it's something to take care of, because I found in 30 years of doing this that usually the bond market gets it right. So anyway, I'm going to wrap it up with that. If you have any questions on what we talked about, please send me an email. I'll try to get back to you later on today or first thing in the morning. And they can go to the doc@marketedge.com. Okay, I appreciate you taking some time out of your busy day to join me on this. I hope you got something out of it. And we'll talk to you next week.